Hello, Money Mavens! Welcome back to Investing Lighthouse, where we make financial navigation easy and exciting. If you are passionate about investing, hit that like button and join our community. Now, are you ready for today's voyage? Because we're sailing into the choppy waters of market valuation. We're on a mission to figure out if the S&P 500 or any broad equity market is overvalued. Alright, let's kick things off with a simple truth. Valuing the stock market isn't an exact science, but there are a few financial tools we can use. So, let's pump up the detail and dive deeper into these fascinating financial waters. Hang on to your hats, folks, because we're about to navigate some serious market metrics. Let's kick things off with the PE ratio, a staple in the valuation toolbox. PE stands for price to earnings. It's calculated by taking the price per share quoted on the stock exchange and dividing it by the earnings per share. So let's imagine a company called Lighthouse Stocks, trading at $50 per share with earnings per share of $5. To calculate the PE ratio, we divide $50 by $5, giving us a PE ratio equal to 10. But what does this tell us? Well, if we look at it from a bird's eye view, a PE of 10 tells us that for every dollar of earnings a company generates, investors are willing to pay $10. It's like saying, hey, I think your future earnings are worth 10 times what you're earning right now. It's like paying $10 for a gourmet sandwich, currently priced at $1, because you're convinced it will be the next big culinary craze. So you might be wondering, how does this translate to the overall stock market? Great question. The PE ratio can also be applied to a stock index, like the S&P 500. Instead of comparing the price of one company's stock to its earnings, we compare the combined price of all companies in the index to their combined earnings. It's like taking the temperature of the market as a whole. If the collective PE ratio of the S&P 500 is high, it may suggest that the market is overvalued, that investors are paying a premium for those collective earnings. It's like walking into a sandwich shop and seeing that all sandwiches, not just the gourmet ones, are suddenly priced at $10. You might wonder, are all these sandwiches worth the hype, or is this a sandwich bubble? Now, this is a simplification and many factors can affect this ratio. Yet, at its essence, the PE ratio for a benchmark like the S&P 500 remains a valuable gauge to determine if the stock market might be entering an overvalued or undervalued territory. And if the S&P 500's average PE is historically around 15 and it's currently at 25, you might think, aha, overvalued! But not so fast. Now here's where things start to get intriguing, and admittedly, a bit more complex. Historical comparisons of the PE ratio can be misleading. Why, you ask? Let me break it down for you. The PE ratio is sensitive to a company's earnings and interest rates. When interest rates are low, like they've been a few years ago, companies' earnings are discounted less, which inflates the E, and all else equal, reduces the PE ratio. Think of the PE ratio and the 10-year Treasury yield like dance partners. When yields drop, more people are enticed to take their money out of low-yielding bonds and put it into stocks, pushing up demand for stocks and hence their prices. This increases the PE ratio as the price part of the ratio gets a boost. Said otherwise, the PE multiples tend to expand. Conversely, when yields increase, that bond is suddenly looking like a pretty attractive and less risky place to park your money, doesn't it? As money flows out of stocks and into bonds, stock prices fall, causing the PE ratio to contract. It's like a financial tango. To illustrate, let's say the PE ratio of our imaginary company Lighthouse Stocks was 10, when the 10-year Treasury yield was 2%. But then, the yield drops to 1%. Investors might start ditching bonds and buying lighthouse stock shares, pushing its price up to, say, $100. But the earnings per share stays at $5. So the PE ratio expands to 20 as you divide $100 by $5. Now, let's introduce a unique character in our valuation story, the Shiller PE ratio, named after Nobel laureate Robert Shiller. It's a bit like the PE ratio's older, wiser cousin. The Shiller PE ratio uses 10-year average earnings adjusted for inflation in the denominator. This adjustment helps to smooth out short-term earnings volatility and economic cycles, giving us a more reliable, long-term picture of a company's earning power. Imagine it as looking at the average performance of a football team over 10 seasons, rather than just one. It helps filter out those one-hit wonders. Here's a trivia for you folks. Warren Buffett, the Oracle of Omaha, has a favorite metric to assess market valuation. And it's not PE ratio. It's the ratio of the total market capitalization of all publicly traded companies in the US to the country's GDP. This ratio gives us a sense of how the total price of all stocks compares to the actual economic output of the entire country. Imagine you're at an auction where the entire US stock market is up for sale. The starting bid is set at the total GDP of the US. Now, if the bidding goes well above the GDP, that's like the market saying, "We think the combined future earnings of all these companies are worth more than the entire economic output of the country." The higher the ratio, the more overvalued the stock market might be. But remember, while this is a valuable tool, it's just one piece of the puzzle. Another valuable metric for determining if the entire stock market is overvalued is the aggregate dividend yield. This compares total dividends paid by all companies in the market, like the S&P 500, to the current level of the market. The lower the dividend yield, the more overvalued the market might be. Imagine this. You're buying an entire orchard for its apple yield, but the cost of the whole orchard is so high that the total amount of apples you're getting for your investment is just a small basket. With such an expensive price tag, you might start thinking, are these golden apples? Am I accidentally in a Greek myth? That's when you realize that the market might be overpriced. Now, we don't need Herculean efforts to make good investment decisions, but we do need to keep our eyes peeled for these signs. So, let's crunch those numbers and make sure our financial apples are worth the price. Now, you might be asking, if the stock market is overvalued, where else can I put my money to work? That's a great question. The answer, my friends, lies in relative value. Imagine you're at a buffet, and the only dessert options are an overcooked brownie and a slightly stale cookie. You would pick the relatively better one, right? Similarly, investors compare the potential returns of the stock market with alternative investments like bonds, real estate, or even sitting in cash. Or for those who prefer something a bit shinier, there's gold. Diversifying your investments across these different assets can potentially lower your risk. Remember the old saying, don't put all your eggs in one basket? In investing, we can make it a bit more exciting. Don't put all your golden eggs in one shiny basket. If these other alternatives offer lower potential returns or higher risks, the stock market, even if slightly overvalued, might still be the best place to be. It's all about relative value, folks. But let's not forget about inflation. This sneaky thief slowly erodes the buying power of your money. If your investments don't generate enough return to beat inflation, you're losing money in real terms. It's like running on a treadmill that's slowly speeding up. If you don't speed up as well, you'll end up falling off. This brings us back to the stock market. Even if it might appear a tad overvalued, stocks historically tend to deliver better real returns than bonds over the long run. In other words, they're better at outrunning that speeding treadmill. Ultimately, assessing whether the stock market is overvalued is not a precise science. And these metrics and ratios serve as tools to aid you in making better informed decisions. The most successful investors are often those who remain disciplined, make decisions based on solid analysis and not emotions, and keep a long-term perspective. So folks, let's stay savvy, stay invested, and keep having fun with your financial journey. If you found this in-depth analysis valuable, please show your appreciation by smashing that like button, sharing it with your fellow investors, and joining the conversation in the comments below. Don't forget to subscribe if you haven't already. Stay curious, folks, and remember, the more we learn, the more we earn.